my pleasure to introduce Bob Steele, who is going to introduce our next interview and panel. Bob, of course, the only thing I'm going to say about him is he is chair of the Aspen Institute board, and we are glad to have him.
Thanks, Judy. It's my pleasure to be here, too, as a board member, and on behalf of all of the trustees of the Institute, just say how excited we are to have all of you. It's great. We have over 20 different policy programs, and they're all exciting, but I think the Business and Society program and what they've been doing is especially important and timely, and we thank all the people that have worked to make that program so special under Judy's leadership. Today, we're excited to be at Bloomberg with this collaboration with the Aspen Institute and Bloomberg. It seems like a perfect fit as we think about these issues, and hopefully you've enjoyed the morning sessions. And now we are excited as organizers for the conversation, and that's a term of art we use at the Institute a lot with regard to having people think about things, pause, and maybe have a conversation that's a different rhythm than the normal conversation, and to talk about things and maybe in a bit more detail. And you can't imagine a better duo, we believe, than the two that are here. The questioner is going to be Eric Schatzker, who is an on-the-air anchor and editor-in-large of Bloomberg Television and the host of Inside Track, where he really gets into lots of knotty issues with the financial markets. I've known Eric for a good while and can tell you he's one of the people I like to tune into for a good perspective, and I think his questions are excellent. And today, to talk about a lot of these issues, he's going to be speaking with Peter Weinberger. And in full disclosure, Peter's a great friend of mine, so it's really a privilege for me to be able to introduce him to you. Peter and I worked together at Goldman Sachs, but before he was there, he worked at Morgan Stanley briefly and then came to Goldman Sachs, where he had a very exciting career and accomplished a great deal for the firm. We don't have time today, but if you looked at Peter's accomplishments, he was a leader in the financial institutions group. He led communications, technology, and media teams. He was one of the founders of our buyout business in terms of covering some of the buyout firms, and so he knew the KKRs and those types of firms at their very beginning. And then, if that wasn't enough, Peter went to Europe and was the leader of all our businesses in Europe and did great things there. So I think we've got, and then to his current position, he and Joe Perella founded their own firm, Perella Weinberg, which is already in a short period of time a leader in advisory work and also asset management. So I'm pleased to introduce Peter and Eric to you and look forward to hearing their conversation. Thank you both.
Thank you, Bob. Folks, as you've just heard, Peter Weinberger has had quite an extraordinary career. But there's one thing that Bob Steele didn't mention, which is that, Peter, I know you're going to hate this. He's the closest thing there is, really, to Wall Street royalty. And I'll explain. His grandfather, Sidney Weinberg, was the senior partner at Goldman Sachs for almost 4 decades. And his uncle John held the same role, effectively, for 15 years. So, Peter, the question that I have for you is, what would those lions of Wall Street, we could call them that, say if they came back and took a look at what we've created?
Okay. Well, I think I think of 2 things just at this exact moment on your question, Eric. And one would be, I think they would be focused on kind of the main event here in this crisis, which is to not lose sight of the fact that it's very important that the U.S. Maintains and develops its role as a world leader. And so I think my guess is they would have been focused on that because that's such a critical thing, and there's so many there's so much other static surrounding the issues. I think that's one thing. The other thing I think they would do or say is that in the 30s, Washington was a magnet for extraordinarily good business people. And back then, and my understanding from reading about it, is that many, many good, young, strong people and senior people went down for $1 a year, and they wanted to do it. And so it wasn't a question of should I, it was a question of can I and how. And that really, that's a big difference from today. And so I think one of the other things they might think is, how can we make Washington a magnet for business people, because I think, as we all accept, there is a lack of business people in Washington right now.
Okay, so they would ask that question. How would you answer it?
Well, I think you have to make it an embracing place. I mean, the moment to me that was the most hostile between government and business was Ed Liddy's testimony, where, you know, here's one of the best business people we have in the country. He took $1 a year, and he stands in front of a committee, and he gets treated very poorly. I mean, I think everyone in that room would now agree with that. You can't do that because people just aren't going to want to go through it. I also think that what you need to do is you need to sort of go against the populist sentiment and say, yeah, we are going to hire some people from, you know, J.P. Morgan, Goldman Sachs, Credit Suisse. We are going to bring them in because they know the markets. And that's the other thing I would do.
The topic for Aspen yesterday, today, is capitalism in the future, and it just seems like it's a good idea to, at least for the purposes of our conversation, establish a working definition of capitalism that we can work around. So let's say that we describe it as a system in which companies are free to generate wealth for shareholders in ways that don't jeopardize the public interest. Does that seem reasonable?
Yes.
Okay, so last night, Indra Nooyi of PepsiCo said companies operating in a capitalist system owe a debt to society. So my question then is, how do you reconcile that duty of care that she described with the way that Wall Street has done business and continues to do business?
Well, I think it's all a matter of balance. I mean, you know, the problem with sometimes these discussions is they're polar. You know, it's not that a company would devote its entire self toward the community or completely neglect it. And I think there are a lot of companies actually that commit themselves to their communities, and they set up foundations. And you know, at Goldman Sachs, we had this thing called Community Teamworks, where every single person in the firm had to work for a cause of some sort around the world, wherever you were, which people today want to do. So I think every company does have that responsibility once they can afford to do that. And I think it helps with clients. I think it helps recruit people. And so I think it has a commercial benefit to it as well.
I mean, you didn't have the benefit of being there, but I think she actually meant it in an even deeper sense, which is to say that, and she gave an example, that Pepsi, for example, has considered whether to change or even eliminate some of its products, like high-sugar soft drinks, if she were persuaded and the board were persuaded that it's for the common good. And I guess the question that comes to my mind, and I suspect some people in the audience may be wondering, is would Wall Street ever turn down a good money-making opportunity because it might not be in the interests of the common good?
Well, I think what's happened, I mean, I'm not sure anyone would do that purposefully and repeatedly, but having said that, if you step back and look at what's happened, that is what happened. And the question is why. I think one of the things I found kind of through this last crisis, and I've now been through a handful of them, is that each small step didn't seem that preposterous. But when you look at the difference between the beginning and the end, you say, how did this possibly happen? And so that's a little bit of the issue as well.
So is a philosophical change required? Because if you look at everything in isolation, no, you're not going to see the one step leading to the next step, leading to the next step, which turns into a snowball, not to mix metaphors, but you follow my thinking. Is a philosophical change required? Is that the only thing that can bring people to a place where they realize the consequences of their actions?
Well, I think it's up to the leadership. I think the leadership of the big financial institutions in the world need to have sort of the equivalent thought that Indra had last night. I wasn't there, but I'm just reacting to what you said. And there are clearly, right now, the reputational microscope is so intense on all the large financial institutions around the world that I am certain that they come across opportunities that they feel would be reputationally damaging to them, and perhaps it would be in the equivalent of a high-sugar soft drink in the financial services industry. And I think now, I mean, that's one of the things that people are probably not doing. So, perhaps the tide has shifted in such a way where that standard has been raised.
Oh, it has been raised for the time being. But I guess as we think about the future, because our conversation is about the future of capitalism, how do we get to a point where these people aren't tempted by the next subprime CDO?
Well, as I said, I mean, I think it has to do with two things. I think it has to do with risk management, and I think it has to do with aligning people's interests from a compensation perspective. I think if you were to say to me, what are the two things that we could do to prevent what you're suggesting, that's what I'd say. And on risk management, I mean, I honestly don't believe that there were people who were purposefully setting up schemes to profit that they knew would fail. I just don't think that happened. What I do feel, though, is that there was less understanding of the risks than there should have been, and less attention paid to that. And so that's how I'd respond to that.
All right, well, I'm going to take your lead because you opened up the Pandora's box on compensation. Clearly, one of the biggest mental struggles for just about everybody who looks at this issue is what to do with pay. And I think it seems fair to say that not many people who take the issue seriously really want to put limits on pay because it kind of smacks of central planning. But you can't ignore the reality that there are a lot of people out there who are just disgusted by the size of some paychecks. You and I have talked about this before. They're tens or hundreds of times what professionals, such as teachers, public officials, even doctors make. So can you afford to ignore that? Or maybe you can afford to ignore that. And I want to phrase it to you this way. What if you had the kind of problem that Lloyd Blankfein of Goldman Sachs has, and he likes to call it a high-class problem, which is to say he's faced with a possibility that he's going to pay out record bonuses before we've even fully exited the worst recession we've had in 70 years. What would you do?
Well, I think that you know, the big firms are going to need to be very creative now because the populist sentiment I get. I mean, it is very, very intense. It is bitter, and I understand it because what happens is you have, you know, kind of social unrest when you have income disparity, but you have really bad social unrest when you have changing and widening income disparity, and that's what's happening right now. So I think that's what's going on. Having said that, I personally don't feel that anyone, if there is an independent entity that is not government funded, let's forget if it's a financial institution because it confuses the point, but who's not government funded, I don't think that anyone should tell that, in our system, I don't think anyone should tell that entity what to pay people as a group or what to pay people individually. I think that decision should be guided by the marketplace, by the board on behalf of shareholders, and by what it takes to keep people. So that's, there are a lot of people who don't agree with that, but that's my own perspective. But I think, you know, to your question as to, I mean, I can't speak to Goldman, but to your question is, you know, what can an institution do? You know, one thing they could do is to take an amount of money that would have been used for compensation and make a commercial investment that would ultimately go to the benefit of those who would have been compensated. So, and I'll just make this up right here. So let's just say that firm X took $2 billion that would have gone to compensation, and they set up a consumer finance company that finances small businesses across the country, and they have 500 branches, and they start a business. Now, why would they do that? One is because if done right, it might fulfill a need that is lacking in the U.S. business community right now. And two is you're not taking away compensation that arguably was due to them. And so, but what you're doing is you're adding risk to it. But, you know, and in 5 years, if that is successful, the people who were originally going to get that compensation perhaps could get that. And perhaps the government, then, you know, the next question is how do you address the issue that the government saved some of these institutions, and perhaps in kind of reaction to that, you allow the government to participate in this venture. I mean, this is, I haven't taken it more than, you know, kind of skin deep, but that's just a thought.
It's a pretty intriguing proposal. It kind of reminds me of what they did over at Credit Suisse when they said, okay, you've got compensation due to you, but what we're going to do with that money is we're going to take it and buy the toxic assets that we haven't been able to sell. So if the stuff is actually worth anything, you're going to benefit in the long run. Now, obviously, a consumer finance organization is a couple of leaps beyond that. But it seems that your thinking on the subject has progressed from a few weeks ago when you wrote an op-ed in the Wall Street Journal, which I highly recommend everybody take a look at if you haven't before, because Peter proposed a comp system for Wall Street that would more closely approximate the way money was paid in the partnerships of old, the partnership that you once belonged to, Goldman Sachs, before it went public, for example. Now, theoretically, of course, that's supposed to align employees' interests and the firm's interests better with shareholders' interests. But does it, going back to what Indra Nooyi was saying, does it, in your mind, fulfill the public interest? Because that seems to be much more now than ever before, and possibly permanently part of the debate.
Yeah, what I had said in that article was that the purpose of the compensation plan that I proposed, and it was more for purposes of an example than it was the actual solution, but the purpose of that was indeed to align an individual with the market and the system. So that was the point of it. And basically, and this is all the old Wall Street partnerships, people had unlimited liability.
It was their money on the line.
It was their money on the line. Almost all of their net worth was tied up in the businesses. And people didn't really take money out of the firm until they left the firm. And so it was less sort of an annual bonus and more so sort of a career bonus, if you will. And the benefit of that is that you think, as is obvious, over the long term, because there's no benefit to you to doing otherwise.
Do you think that we're getting closer to that model with some of the compensation schemes that have been proposed by individual firms, some of what we've heard from governments on this side of the Atlantic and the other side?
Yeah, I think it's right smack in the middle of the debate, and it's obviously timely because we're about to hit the end of the year. And I'm certain there are a lot of conversations going on, and some of those have been well publicized, both with the government, the firms where the government has a significant investment, but also the firms where the government does no longer have a significant investment. All those conversations are going on, and I think they're all talking about the same thing, which is that we've got to figure out a way to do this that's sort of acceptable in the public light, but also consistent with our economic system.
A related issue to this is something that the Aspen Institute has taken up very seriously in the past, and it's the whole concept of short-termism. I heard a fellow named Jeff Beattie, whom you may know. He works for Thomson Reuters. He's a vice chairman there, worthy competitor of ours, of course. And he learned about making a fortune at the knee of the Canadian billionaire Ken Thompson, say that the problem in our system is that it has evolved over the past quarter century to favor traders over builders. And I guess even if you adopt the kind of compensation system that's being adopted now, which is to say includes things such as clawbacks, it just seems to me that the risks being taken by these firms are not the risks of builders, i.e. capital providers and entrepreneurs. They're the risks of traders. And ultimately then the financial system and the taxpayer rewards people for, to reduce it to its absurd minimum, buying low and selling high.
Well, I wouldn't agree that our system is, kind of short-term oriented in that sense, in total. Because look at Bill Gates and Warren Buffett, who are builders without question, and they're the two of the wealthiest people and most successful people in our country. The other thing, though, I would say, though, is that trading. I think sometimes people describe trading as this useless exercise. Trading is not a useless exercise. It's a very important market feature around the world that connects issuers of capital and investors in capital. And the more liquid a trading system is, the lower cost of capital is, and the better off society will be. So I wouldn't necessarily sort of label trading in that way.
But I think just to put a finer point on it, I think the criticism that he was leveling is at, in general at society not favoring builders enough, but also at the financial system for not operating in a way that favors builders as much as it favors traders. Do you agree with that?
In part. I think again, though, the way that you get away from that. Well, first of all, let me say yes, in the sense that there are people who have benefited enormously from trading Yes, it may provide a benefit to society, but yes, they benefited from that, and they may do that and not build. So yes. But on the other hand, I do think the question is going forward. You know, that's fine, and the trading markets are vital. You know, we'd all be a lot worse off without them, believe me. But the trading markets need to be aligned, and that's where I come back to alignment of compensation, but also risk management. And it's a complicated kind of recipe of a solution, but that's how I think about it.
I think a topic that we can't afford to ignore in this discussion of compensation and risk management is the whole concept of too big to fail. One of the panelists last night, for those of you who were at the event at the New York Public Library, was Nassim Taleb. And he would argue that the mere existence of Goldman Sachs proves that we have, and I'm just using Goldman as an example here, proves that we've privatized profits and socialized losses, because if Goldman pays out record bonuses and at the same time it's too big to fail, the taxpayer would end up covering the losses. So if too big to fail persists, and many people say that it does today, in fact, too bigger to fail is how some people describe it, should the public not participate in those profits somehow through something like a public dividend? Not a tax necessarily, but some kind of a profit-sharing scheme.
What's the difference between a public dividend and a tax?
I guess in principle, it's a matter of principle. But let's call it a tax then.
Okay.
Well, we've established that it would be a tax.
Okay, so I think the way I think about too big to fail is let's talk about the big part and the fail part. So on failing institutions, right now there is a very well-developed system which deals with failing banks. And it's called the resolution process. And so everybody knows about that, and that is what it is. And
the one that's run by the FDIC.
Correct. So that's that. Now, the next question, though, is, and something that's being very heavily debated now, is how do you deal with that challenge with financial intermediaries, so non-banks? And my view is that it ought to be the exact same system. What that system basically does is if a bank fails, the government takes control of it, allows it to continue to function, but that's allowed to happen because of what happens to debt and equity securities of that particular bank. So let's take away the big part, but that's sort of how I think it should work. It's well developed, it makes sense, and it seems to have worked well so far. I think on the large side, the question really looks to the systemic risk kind of oversight. And that's also, as you well know, is being debated right now. And my own view on that is that it should obviously include the most senior people in the different parts of the government, including the Treasury and the Fed and the FDIC. But my own view on that is that it should not be a Fed-driven or led process, because that perhaps could compromise the Fed's independence, but it should be more an independent person who oversees that systemic risk panel, if you will, that does that. And so that's really how I think that should be done. You know, Paul Volcker has an idea which has been well articulated, and Mervyn King also supports it, which is to basically split up the financial institutions. So you have the commercial banks, the old-fashioned commercial banks that have FDIC-insured deposits. They are just that, banks. They do not engage in the trading businesses. And then you have other institutions that are free of that sort of oversight, but they also won't be saved. And security holders know that, so they won't allow it to grow. That's the concept. That worries me because that could be perfectly executed, and we could be sitting here in 10 years without the world. The 10 most successful banks in the world could not be from the U.S. I don't want that either. I don't think anyone else does. And so that's the other kind of side of that coin.
How then should we rewrite the rule book? I mean, if you were to look at the way financial services is done, it's not even, you can't even really split it along those lines. You've got, I was tallying them up beforehand, at least 5, right? You've got pure advisory work, you've got money management, both of which Peter Weinberger does. You've got deposit taking and lending, obviously what the big banks do. You've got the liquidity provision, you talked about that before, and you've got prop risk taking, which would be akin to, say, what a hedge fund does. But a hedge fund like Citadel doesn't just take prop risk, it's now getting into pure advisory work, and maybe it's going to get in, it already does, it plays a role in providing liquidity, and for all we know, they may get into other areas. So regulators today are forced into a situation where they have to take this one-size-fits-all approach. If you could go back to square one and rewrite it, the rule book that is, how would you do it?
Well, I think I'm sure there's wisdom in Paul Volcker's solution, because he's a very wise man. I think there's, in a way, you're right, it's kind of unscrambling the egg now because all these institutions are so intertwined. But I think there may be some solution where you do indeed have a highly regulated banking entity alongside a series of businesses that are still regulated, but in a different way, and are not kind of saved. And if you could put those under one roof and allow the institution to become a leading world institution, which, back to my original comment, I think it's really important that we maintain a focus on that. I think that's, I'd probably think about it in those terms.
Any more? I mean, that's a very sound general approach, but how could you specifically guarantee that we would have those world-leading institutions that wouldn't be encumbered by the inability to do business, say, the way a bank in, who knows, China. I mean, obviously, China has growing banks. We hear a lot about regulation in France. We hear a lot about regulation in the UK. And they may end up adopting very similar approaches to the way that we're regulating here. But there are emerging financial institutions in Brazil, China, India, et cetera, that aren't encumbered by any of these regulatory oversight processes.
Yeah, but that's happened for many years. I mean, if you look around the world, let's just say pre-crisis, if you look around the world at the precise regulations on institutions in, let's just say, Japan, China, Singapore, the U.S., Canada, France, Germany, the UK, they're all a little bit different. Now, I actually think the regulatory wave is, if there's one good thing about the global crisis, it's that it's affecting everybody. And I think the regulatory wave, in a way, is encroaching everybody to some extent. But they're all going to be different. And many industries are like that, too. I mean, in the defense industry, for example, the regulations are very different around the world, and they handle themselves very differently. But people end up finding a way to compete.
The issue that we're effectively talking about here is the role of the financial intermediary in the capitalist system. And as you know, for years we were told that America really didn't need to make that much anymore, that we needed to be a services-driven economy. And many of us were told that no service was more valuable than financial services. Now, if we look back at this crisis, if we look back at the S&L crisis, if we look back at the Latin American debt crisis, all the crises that have befallen, let's say, and that's a very passive way of thinking about it, the financial industry in the last 25 to 30 years, have we, and I want to ask this question of you philosophically, have we overvalued the role of the financial intermediary?
Well, I don't know if we've overvalued it, but I think what you're saying, I think the point you're making, if I understand it right, is that the financial services contribution in the United States to GDP is, whatever it is, 35%. And that's too much. And why is that?
Or whether it's too much, it was for a period of time, and then you could look back at the, what was it, almost 7% decline in GDP in the second quarter and ask yourself how much of that was the consequence of financial services. So the gains that we might have seen were wiped out by the very same industry that brought them for us.
Well, the analogy I would use is that when you have a company, ideally the way you'd set up the company is to have a bunch of diverse business streams that are counter-cyclical. What that would do for a company is to provide a steady earnings growth rate. If you overlay that analogy onto the United States, what happened is that one business, financial services, just got too big. And we benefited from it enormously, from our tax base and other things, and then we suffered from it enormously. And it's not all that different than a company that has an over-concentration in a business.
But the difference, though, is that people would say the general public suffered along with you.
Yes. Well, the analogy to that would be the shareholders of the company. But you're right. The general public did suffer, for sure, from the concentration. But it has to, I mean, the best economies around the world over time have been those that have a balance between different bases of industrial activity. And I do, to your point, if you were to add up all the services in the economy, not just financial services, but consulting and accounting and advertising and all the kind of the people businesses, my guess is that's I don't know if that's half of the GDP, but it's probably pretty close. That's a lot. That's a lot. Now, on one hand, I think it's good for this country to export talent that way. So, there's some benefit to that. But I think then you have the cart ahead of the horse, and you got a big cart and a small horse, and that's going to be difficult.
I want you to try and help everybody in the room here understand how Wall Street comes up with some of the numbers that the rest of us ultimately have to bear as shareholders, members of the public. And I went back and looked at a deal that Peter Weinberger had been involved with recently, PepsiCo's purchase of Pepsi Bottling Group. And because it's a public deal, the fees have to be disclosed. So Pepsi Bottling, which is being acquired by PepsiCo for about $10.5 billion, is going to pay $43 million to Morgan Stanley for advice on that merger, and is going to pay $2.5 million to Peter Weinberger for providing a fairness opinion. And to a lot of people, those seem like really big numbers. So what I think might be instructive in the context of this discussion of capitalism and Wall Street's role is to walk us through how we get to those multi-billion-dollar numbers for things that you'd wonder if it were if it were a law firm billing on a per-hour basis, even at $950 an hour, would we ever get to those numbers?
Yeah, I mean, I think your question is how there's an industry called the merger and acquisition industry, and it's been around for a long time, and clients have been paying investment banks for merger and acquisition services for many years. And your question is, why do they pay what they pay, which is a perfectly good question. I think the reason they do it is because in an acquisition, the difference between a successful acquisition and an unsuccessful acquisition has very, very significant consequences. It could have significant consequences to the company. It could have significant value consequences. And there are lots of other parts of that make it an important thing for a company to do. So if Pepsi, for example, in that situation, felt that in a $10.5 billion deal, paying that amount of money allowed them to complete that deal successfully. My guess is that, I mean, we weren't working on that side of the table, but my guess is that she would have described it to the board in that way, and the board would say, if it's in the best interest of our shareholders, we should do that. And so that's how the discussion usually goes.
We were just talking a few minutes ago about American financial services firms, how they're going to be able to compete internationally. Let's think of it in the reverse context, which is to say we're becoming more and more reliant, it would appear, on emerging markets, developing nations for growth, China, for example, for capital. Think of sovereign wealth funds from the Middle East. How might those influences change the way that our capitalist system evolves?
Well, I think about protectionism first, and I think about it in the context of our global expansion, because protectionism exists all over the world, and it exists here in all sorts of different ways, and it's always going to exist. But I think the tendency in a period like this is that people meaning countries, tend to look inward. And to the extent that we do that and we become more protectionist than we are, I think a lot of things will happen that will not be great for our economy. And I don't think we'll be able to expand around the world as we would like to, given particularly some of our leading industries.
Is that going to be the natural response, though, that the influence of the way business is done in those countries is going to trigger a protectionist response?
Well,
or might people become more open-minded about thinking? Nobody would describe the Chinese economy right now as a capitalist system, but it's moving in that direction. But it might end up being a different form of capitalism than the one that we practice here.
Yes, agreed. But I think too the thing is that let's think about this on a commercial perspective. So in other words, what's the commercial relationship between the United States and the different emerging markets around the world, just to take your point. Mm-hmm. And then also, though, what we have to think about is the pools of capital around the world, because what we need is capital to be invested in this country as well, both internally and externally. That points you to the sovereign wealth funds, and what do they want to do? They also have an aversion to protectionism, as they should. in our country. But we really, I've always been a big supporter of open flows of capital around the world. And the sovereign wealth funds are sort of out of favor in terms of a discussion point. But they are enormous pools of capital. They're very sophisticated people. And they're watching the U.S. very carefully. And I personally think that they are underinvested in the recovery of the U.S. economy and the U.S. financial services system generally. And I think they're all thinking about how to handle that. But we have to be careful about that because we can't, scaring them off would be at great expense, in my view, to this country.
And some would argue that the experience of some of those sovereign wealth funds with the investments that they made in financial services firms did scare them off for a little while. So how do we bring them back?
Well, I think these institutions are really, really smart people, and the Middle East now is generating hundreds and hundreds of millions of dollars every day of excess liquidity. So they're going to make mistakes, and they know that, and they're never going to pick the bottom, and I think they understand that. But I think, how do we bring them back? I think we embrace their interest, and they don't want to control companies generally. They do sometimes, but not generally. And so I think that what we need to do is just to be open to all capital, not just the Middle East, but to China and Singapore and Norway and everywhere else around the world.
That ultimately will be to our benefit.
I believe so.
I want to come back to one more question about regulation before we open it up to the floor for some questions, and that is the pace of regulation and or the lack of heavy-handedness. I suppose it depends on how you look at it, which side of the table you're sitting on. But I thought of it this way. If there were an ecological disaster here in the United States, citizens would expect the government to react quickly, decisively, to impose controls, restrictions, to contain the fallout, but beyond that, to make it all but impossible for the crisis ever to be repeated. And there are a lot of people out there who look at what's going on in Washington right now as it concerns regulation of financial services and say that they don't believe that that's happening. And that they would want a response, a regulatory response, a legislative response that establishes, that contains the fallout, prevents things from happening in the future, does it quickly, does it decisively. Just over the last few days, that's kind of what we've begun to see take place in Britain, and here the wheels of change seem to be moving much more slowly. They're disgusted by the influence of lobbyists for the financial services industry, et cetera. How do we tackle that problem? How do we invest the general public with confidence in the regulatory response to this crisis the way that they would have confidence in the regulatory response to an ecological disaster?
Well, I don't know how to draw the parallel exactly to an ecological disaster. I guess you'd have to, the issue about this crisis is that it wasn't just the financial services community, it affected everybody. And so I think you have to, whether or not an ecological crisis would have that effect or not, I don't know. But I think it really is, to me, from a regulatory point of view, in terms of how to instill confidence and how do you do that? I think the one thing we could do is have the leadership in Washington come together and work. You have a united front, which I know is a very, very complicated and difficult thing to do because each agency has a different. They're like a different stakeholder in a company, and so I think that's one thing that would be really important to do. The other thing too I would say is that I don't think regulation is not designed to eliminate bubbles. There is no regulatory system that could do that, and if there was, it would not be an economic system like the one we have. But what we do want it to do is to kind of mute the highs and mute the lows, and that is really something that we need to try to do. And I think we do need more regulatory oversight. I hope it's not too invasive. And I think it has to be presided over by, as I was saying earlier, by a systemic risk regulator who can, allow institutions to fail, and then in the event that there is a large institution, the failure of which would jeopardize systemic stability, to have a view on that.
What you said, Joe, though, and again, we're going to open it up to Q&A in just a second, made me wonder about the role that these. How does the Fed, let's say, as a regulator, respond in the future? We just said that there's a lot of excess liquidity out there. We just said, so that would suggest that once these people start bringing their money to market, we're going to see asset prices rise even beyond where they've come thus far. and a lot of people think that stocks and credit products are trading at some eye-popping valuations right now. So how do you draw the balance between the role of liquidity, the need for regulators to address asset prices in the hope of moderating bubble effects?
Well, I think part of it could be the reduction in leverage. I mean, there's nothing wrong with someone investing at a high level and losing money. That's what our system's all about. In the same way, there's nothing wrong with someone buying at a low level and prospering. But I do feel, though, that overall, the systemic implications of sort of a disorganized process, and I think could be very harmful.
Peter, let's open it up to questions. There are some mics around, and we've got a question over there.
Hi, I have a comment and a question on compensation alignment, which we were talking about earlier. I'm from the Capitalism Institute, and one of the things that we've done, in fact, at the behest of Ed Freeman, a name that many of you may know, is sort of the father of stakeholder theory, and he came up with the notion of stake options instead of stock options. And we're actually investigating that on a systematic basis to see that if we could come up with a metric that actually looked at people and their compensation in terms of, some subjective and or other criteria by which they fulfilled their presumed obligations and missions to the group of stakeholders. And we've done some initial exercises, and ironically, for some of the firms, the CEOs would actually do better. And so it's not automatically a way of cutting down compensation, but it's a way of balancing out the drivers into that. And I was wondering what your thoughts were on that.
Well, it's a very interesting thought. I mean, what I was saying earlier is that I was focused on a much more traditional compensation model, and my only point was just have a career-based bonus system as opposed to an annual-based bonus system when we really don't know what the effects of someone's contribution is. I think what you're saying makes a lot of sense. I think particularly today, I think trying to gauge one's success with various different constituencies, not just the bottom line, I think makes a lot of sense. I think the challenge to me would be doing this in a way where you could roll it out to many, many thousands of people. And it's a very, I mean, if I was the head of a compensation committee at a company and you were the chairman of the board and you told me to implement that, I'd struggle a little bit with how methodically and mechanically to do that, because you have to kind of to roll it out. But I think it's a really interesting idea.
We've got a question at the front table right here. Just a moment. Let's get the mic up here, if we might.
Hi, my name is Sarah Stranahan, and I have a question about regulating systemic risk. It seems like most of the debate has been about where we regulate systemic risk, whether it's the Fed, whether it's a council, whether it's an individual. My question is, how do we regulate systemic risk? Do we have metrics to do this? Can we preventively identify and modulate systemic risks? When we look at, I mean, what you're talking about is a resolution process for dealing with too big to fail institutions, but that's a little bit too late for the American public. In other words, the cost to the public of the risk is more than just dismantling that institution. And so is there a proactive, do we have metrics, do we have mathematics to actually identify where systemic risk is occurring in the system? So for example, if you look at derivative tradings, do we know, could we look at the credit swap, field and say, okay, there's this much excess riding on these, on these few bets or on these few underlying assets, and therefore we're going to limit trading in this area. So I just don't quite understand how we think we're going to modulate systemic risk.
Yeah, I think, well, first of all, you're right. And if you look back over the crisis, there was no circumstance where a regulator would come into a large securities firm and say, I know you haven't recognized these risks, but here they are. Can you please shut them down? There's not a chance that's going to happen because of the sophistication and the fast-changing nature of the industry. So I think you're right about it being sort of too late in a way. I do feel, though, that that would suggest that a partnership between business and Washington, I think, and the government, I think, makes a lot of sense, because I think it has to be kind of one and the same. And right now, the Treasury, and more so really the Fed and the FDIC, have an enormous amount of data on all the financial institutions in this country. I mean, a huge amount of data. And the question is, how do they kind of manage that? And I think the way to do that is to connect the business community and the political community as risk management is further developed. And I think that's really the only way you can do it.
But doesn't that, Peter, raise the question as to whether or not the private part of that partnership isn't always going to be one step ahead of the public side of that partnership?
Yes, but that's why, to me, that's why you have to set up a natural alignment. Because, and I know I keep coming back to this, but if you align the fortunes of the individuals with the fortunes of the system, then it's self-governing is the wrong way to say it, but there is that kind of dynamic that hopefully would occur.
But how do we create the incentive for that to take place? Because that's the one thing that just seems to be missing from the equation. It's that the private part of that partnership doesn't want to come to the table, doesn't necessarily, the public definitely does. People in this room, it would appear, definitely want to see that happen. But how do you incentivize financial services industry to join in that partnership?
Well, I think there are a couple things. I mean, one is back to my point on leverage. I think that the system is deleveraging now and continues to deleverage. But
that's very much, through self-interest.
Well, two things happen when you deleverage. One is that you lower the risk of an entity, and two is you lower the profitability if you're growing. That's important to do, and I think that regulators need to understand that and understand a business well enough to overlay their views on leverage, and I think that's happening.
All right, we've got a few more hands up here. Let's go right here to you in the tan suit. And
you had indicated in a question that you wanted him to comment on if you could have waved a magic wand, what would you have done or where would you put us back to? So would you have passed GlassSteagall? And would you have thought of, OFEO or other organizations overseeing credit default swap risks? Where in the timeline of our regulation would you wish we were?
Well, see, part of the problem is that GlassSteagall is a perfect example, because GlassSteagall was a very smart thing to do at the time, and conceptually it's addressing the issue that we have now, and it's sort of Paul Volcker's point, which is to kind of separate the bank from the trading organizations. But the problem is GlassSteagall itself, what they actually did was they prevented underwriting. Underwriting at the time that they did that was a very risky activity. Underwriting now is not without risk, but that's not what we're all worried about. And so it's hard, in a way, it's hard to look back and pick the different over time, because the markets have become so complex and so sophisticated that a lot of the old kind of regulatory pieces don't really make that much sense anymore.
But you're not helping me understand. It's not a complete answer.
So tell me, what's your question?
Well,
where were mistakes?
Should we have overturned GlassSteagall when we did? Is that a good thing to do?
Well, I think to me what happened is that back in the late 90s, I think if you're looking for a view on when we were really focused on the competitiveness of the U.S. financial system, and we started to deregulate at every turn, that's what I wouldn't have done in hindsight. Now, at the time, did I say we shouldn't do that? No. But now that I look back on that's what I probably would have not done. And I think in that context, I think we could have done a lot differently.
So, living in Washington with the lobbying force that we have there, what would you advise your lobbyists or what have you? Where should we be now? What would you tell the Senate Finance Committee?
In terms of overall regulation? Well, as I said, I think my view on the regulation, specifically as it relates to failing institutions, the new piece that I mentioned was the resolution process with financial intermediaries. I think that's a very good idea, and I would encourage the Senate Finance Committee to consider that and ultimately adopt it. To me, I mean, I have a pretty simple view of the whole kind of resolution process, which is that if you buy a stock in an entity that fails, or if you buy debt in an entity that fails, and when I say fails, it's not worth anything, I don't believe that one should be paid for that. I don't think you should receive back any value for that. And I think that's how the whole resolution process works. And I think it could be extended because I think it's an effective process. Then on top of that, I think as it relates to the Senate Finance Committee, I like the idea of this council of the systemic regulators.
One quick question to follow up on that, Peter. Do you think that the resolution authority needs to be funded? Do you think that the funding should be pre-funding, which is to say these firms effectively pay for their own funerals in advance, or do you think it should be the competing proposal, which has come out of the administration, that you kind of mop up the mess afterwards? Either way, it would be a tax. You could call it a tax. You pay into the fund beforehand, and there's the incentive to manage your business well so that you don't have to pay more. But, of course, everybody pays the price, or that, even worse, perhaps, after the fact, only the survivors pay the price.
I think it is better to raise the capital, if you will, before the crisis, not in the crisis. And so, therefore, I'm supportive of the kind of pay-as-you-go approach, where you accumulate a fund along the way, and that fund is used to address issues in a crisis.
All right, we had a bunch more hands. We've got time for 2 more questions. So who would like to ask a question of Peter? There's a gentleman right here.
Thank you. Now, it would seem to me that there are 2 fundamental misconceptions floating around, and unfortunately, policy is going to flow from that. One of them seems to be a deep-rooted notion that you can prevent bubbles from occurring. In the uncertainty of information, which defines our existence, because life on Earth for individuals is finite, knowledge is infinite, it seems to me we have worked out a process of, through trials and error, figuring the system out. So the idea of having a bubble-less sustained economic growth is a wrong one, but flowing from that is this focus on compensation. It would seem to me that it is not the amount of volume as much as the focus should be on the alignment. Now, on the alignment of compensation question, I'd be interested in your thoughts on, would it then eventually lead us back to, and it's not a bad scenario to go back to, of having smaller, focused financial institutions and not behemoths? I'd be interested in your views on that.
Yeah, I mean, that is a risk. I mean, I though worry that we wake up in a couple of years and we've dismantled the financial system. And what we've done is we've reduced the risk of failure and of institutions that are too big to fail. That's the good news. The bad news is, we don't, as I was saying earlier, we don't have leading financial institutions. And I think that for this country not to have leading financial institutions in the world, well, it'd be different, let's put it that way. So, but I think what you say is right, though, that the alignment issue does have a natural governor on size because of people's financial self-interest. And that's not all bad. And, perhaps that works with some of the more, some of the institutions that are more on the proprietary side, if they can raise the capital, than it would for the big kind of lending and saving institutions.
And we have time for one more question. Right over here, please.
Peter, a part of the financial services industry where the agency and incentive problems are the most perverse, in my view, is in advice given to individuals. Do you think the Consumer Protection Agency framework goes far enough? And can you see a world where the outcomes of financial advisors are actually tied to outcomes of their clients, particularly people who are retiring or about to retire and can't afford to lose money?
Yeah, I think it's a very interesting question, and I haven't really thought about it too much, but I think alignment should really be used really across the industry. That industry, you know, if you're you know, Wells Fargo and have 25,000 people, you know, who are out talking to clients, I think it's a difficult thing to kind of orchestrate and manage. But I think there's absolutely no reason why the performance of you shouldn't be linked to the performance of your clients. Now, of course, there's the other extreme where you go too far, and you have to make sure that you don't create sort of the option syndrome of you know, trying to create value. If you do, you get richly rewarded. If not, you can leave and go do something else. And so that's another thing you have to be careful of. But I think the alignment concept, I think, is very useful across the whole financial services industry, including the retail brokerage community.
I think we're all through because of time, so let me just come back and say thanks to Peter and Eric, and thanks to all of you for your questions and a good panel, a good conversation. Thank you.
Thank you.